Hey everybody, it is good to be here today. It is Thursday, time for investing in dividend stocks. My name is Brent Moores. I'm sitting in for Cam today. He's out for a little bit. He'll be back in I think 3 weeks there. But glad to have you. And I want to talk to you about something a little different today. A lot of times we kind of deliberately avoid real estate stocks, REITs in this webcast today. I intentionally want to target REITs here. So we're going to do that in just a little bit. Before I do so, let me just mention a couple things. One, if you're interested, you can follow me on X or you can follow Connie on X. Connie is helping me out in the chat, Connie Hill. I've been working with Connie for over 20 years now. So our X handles at Connie Hill CS, at Brent Moores CS. And there you go. Hey, let me mention I need to go through these disclosures real quick here. Remember, the material today is intended for general, informational, and educational purposes only. It's not an individual recommendation or personalized investment advice. And there are risks associated with dividend paying stocks, including but not limited to the risk that stocks may reduce or stop paying dividends entirely. That's certainly a possibility with dividend stocks in general. Schwab does not recommend the use of technical analysis as a sole means of investment research. I'll be using the Schwab website today. I know a lot of times we use the Thinkorswim desktop platform in this webcast, but I do like to mix it up. And so we do mix it up in this class today. I'm going to be focusing primarily on the Schwab platform. All investing involves risk, including loss of principal, and past performance is no guarantee of future results. Risks of REITs are similar to those associated with direct ownership of real estate, such as changes in real estate values and property taxes, interest rates, cash flow of the underlying real estate assets, supply and demand, and the management skill and creditworthiness of the issuer. Diversification does not ensure a profit. It does not protect losses in declining markets. Now, the first thing I want to do here today is just mention this. This is something I think most of you, at some point, if you haven't seen it, you'll see it at some point. You'll see a pie chart. And the pie chart will be broken up and it will be like an asset allocation, suggested asset allocation pie chart, okay? And it'll be broken up and there'll be different spots on it. And what I'm going to show you isn't meant to represent percentages. Like, this is just an example, okay, of what you should do. But often what people will do, or they'll say, well, I'm going to have US stocks, okay, US stocks as a chunk of that. And I may have bonds, or, US bonds as a part of it. Fixed income investments as part of this. And maybe you'll have, I don't know, cash as something. Maybe you'll have commodities or something else. Often what they'll do is they'll break it down and they'll say, hey, I want a certain portion in real estate, okay? And so when you talk about real estate can be either an asset class, such as what I'm showing here. These are all asset classes, bonds. And by the way, you can go a lot more into this. We have international stocks, right? I'm not going to spend the time writing it all out. There's international stocks, international fixed income. That's a possibility too. Gold, precious metals, we talked about that. Real estate is sometimes listed as an asset class. And then sometimes real estate is listed as, in US stocks as one of the 11 sectors out there. So either way, it comes up in the conversation quite often, real estate. So it's probably not something we should ignore. I'm not telling you whether to invest in it or not, but I'll tell you what, a lot of like 401k plans have the choice of, US stocks, a real estate fund or something. You're confronted with that decision as you do this. Now, as you do so, you have the choice of how am I going to invest in real estate if you decide you want to invest in real estate. Well, one possibility is you can you can go out and buy real estate, right? You can go out and buy a property. And let me just bring up my, there we go, my Schwab website. You can go out and buy a property, but that's a problem. I mean, that can be a challenge. You want to buy an apartment complex and you don't have tens of millions of dollars, it's probably not going to happen, okay? Or you can buy one little thing, or, it becomes a problem. And that's where REITs, or real estate investment trusts, come into play here. So that's what we're going to talk about today. This is what we're going to focus on today. Now, there's other choices as well. There's ETFs or mutual funds that you can invest in real estate too. I'm not going to get into that today. We have a webcast on Mondays that deals with ETFs. We have a webcast on Fridays that deals with ETFs. I can't get into that, but just realize that is an alternative. But there are individual REITs out there that you can buy. And so let's just kind of start off with that. And that is, you can invest in REITs for just appreciation, for dividend purposes. This is a dividend stocks webcast, and they're known to have higher dividend, decent, reasonably high dividends. That doesn't protect you from anything, but if we're talking about dividends, it's hard to exclude real estate. Also diversification. Okay, I mentioned all of those things. But if I go to schwab.com and I click on research and I click on stocks and I click on stock screener and I pull this up, and I'm going to go, and I'm just going to go to basic, and I'm going to go to sectors and industries, and I'm going to click on real estate. It's going to give me a variety of types of REITs here: diversified, healthcare, hotel and resort, etc. So those are some types. But let me just narrow it down so we're not looking at everything out there, by some common stuff that we look with dividend investing. So I'm going to click on dividends, and I'm going to say I want a dividend yield, I don't know, we'll say 3% or higher, okay? 3% or higher. And I'm going to go down, and I'm going to go down to debt to equity, and we're just going to say less than 100%, okay? And I can click on view matches. Now, here's your industry, and you can see various types of REITs here. Let's talk about some of these types of REITs. As soon as I mention this, what do we mean by this REITs, this real estate investment trust? A real estate investment trust is a trust, it collects rents basically. So consider that apartment example I gave just a minute ago. They buy an apartment, the REIT buys an apartment, and what happens? People pay their rent every month to that apartment. You're not doing the management as a REIT, owner of a REIT, but the REIT manages that, and you get to participate in the rents that people pay. That's one type of REIT. We'll talk about others, but REITs collect these equity REITs, and there's another type of REIT called a mortgage REIT, which we will talk about here, that's a little different, but equity REITs, to start us off here at least, collect rents on physical properties. All right, that's the first thing. Now, question in the chat. Why did I pick 3%? Here's why I picked 3%. There's nothing magical about 3% in terms of the yield that I chose. But if you're looking at kind of average stocks out there, the average S&P 500 stock out there pays a dividend yield of maybe a little bit over 1%. Okay, so if we're dividend investors, I think we need to go north of that in order to really call ourselves a dividend investor. Yes, we can find a stock that's paying or a REIT that's paying a 1% dividend, perhaps. There's not probably going to be many REITs out there that do that, but if they do, then it's ultimately that's not making that much difference in terms of returns. Most people shoot for much higher rates than that. Why not something really high, like 6%? And this is something we'll probably mention a little bit more later, but when you start to get higher numbers, like 6, 7, 8%, which you can find out there, no doubt, it implies more risk, a riskier investment out there. We've talked about this in past webcasts many times. When you start to see very high yields, there's a higher risk perceived with those investments. And if you think about it, it kind of needs to be that way, because let's say something's paying a 10% dividend and it didn't imply any more risk than any other trade. What would everybody do? Everybody would rush and buy that stock or that REIT because it pays such a high dividend with presumably the same risk. What's going to happen to the share price if everybody goes out and buys that? Share price goes up, the yield goes down, and it equalizes. So when you see the higher yield, kind of consider higher risk there. All right? Now, Ricebird says, don't they have to pay out a certain percentage by law? Yes, they do. That's another thing I want to mention here. REITs have to pay out 90% of their income, 90% of their earnings by law. 90%. So if you do this, and in fact, you know what I'm going to do? What I'm going to do here is I'm going to change this scan. Let's modify this results a little bit, and let's throw in a payout ratio. Okay. And I'm just going to go payout ratio 5-year. I'm not actually going to narrow it down by that, but let's run that scan again here. And let's look at that payout ratio, because very often in this webcast, we talk about payout ratios. Let me scroll over. We talk about payout ratios, and we say, oh, we want a payout ratio less than, 60% or 70% or something like that, in that order. Notice the payout ratio here on this. The payout ratio is high. They have to pay 90% out. That's how REITs do it, okay? So you can't use our normal payout ratio parameter in here when we're trying to narrow down results and look at these REITs, because they're all going to show high numbers on that, all right? So that is a good question, and I appreciate you doing that here. So I want to just kind of look at some of these here. And so let me just start off. AVB, okay? Multifamily residential REITs. If we want to know more about this, okay, I'm going to click on this symbol. It's going to just bring up this quote box, but I'm going to click on this. And you may want to know what it does. Well, what you can do you can go over here to its company profile, and it's not going to really tell you a lot there, but you click on read more, and we can see it develops, redevelops, acquires and manages communities in leading metropolitan areas in New England, New York, New Jersey metro area, etc. Held their ownership interest in 320 communities containing apartment homes, and so it'll give you an explanation of what these are. All right, so let me go back here and let me close this out. So that's an example of a residential REIT. They buy apartments, for example, or something similar, and they invest in those. Let's look at some others though, okay? So I want to look at some other types of REITs, and I'm just going to go to one that I'm familiar with here, if it will. Let's go to OO, okay? Realty Income Corp. So I'm going to click on this, and I'm going to click on this, Realty Income Corp. This is an example of a retail REIT. Let's read a little bit more about this. So I'm going to click on company profile, and see if it says what it does. Real estate, this one doesn't give us much information here on this, but I'll tell you what a retail REIT is. But even though it's not going to tell us here, it says retail REIT. A retail REIT is they own retail residential, retail real estate. So, hey, maybe they buy a strip mall, or they buy some other property, maybe one of these malls or these areas where they have an anchor, big grocery anchor store area, and they buy that. And then they lease out those properties to individual stores. People pay their lease, and the REIT takes in those. So you can see different types. That's a retail REIT. There's industrial REITs. Here's an industrial REIT. What do industrial REITs do? Industrial REITs buy industrial properties, right? I know someone who owns an industrial property, and they rent it out to people. They lease it, and they bring it in. But that's out of possibility for a lot of people. You just can't buy industrial buildings and do so. So that's an example of another one. So you can see a whole bunch of different types of these REITs. There's healthcare REITs. One I know of that, off the top of my head, although I don't see it listed on our search results, is one called DOC. Okay, it's a healthcare properties REIT. Let's just look at this one real quick here. Okay, and James mentioned in the chat, hey, Realty Income, or O is the ticker symbol, is a dividend aristocrat. That means they've raised their dividends 25 years in a row, market cap requirements, and that's something we talk about a fair amount in this webcast here. So Healthpeak Properties, it's an S&P 500 company, high quality real estate focused on healthcare discovery and delivery in the United States. So what are they going to invest in? I don't know about all the specifics here, but let's see. It says outpatient medical, labs, continuing care, retirement, medical buildings, hospitals, and lab buildings. That's kind of what comes to my mind when I talk about healthcare REITs, as very often they're hospital or medical office buildings, stuff like that. There's storage REITs, where they buy storage space properties. Public storage, PSA, is an example of one of those. Let me just pull that up here. I think that was on our list, although I'm not 100% sure. It's a REIT that primarily acquires, develops, owns, and operates self-storage facilities. Okay, quite a variety here. And let me just mention this. Let me just mention one more thing here. Sometimes they're called specialty REITs. Let's do American Tower, which I think is one of the largest REITs out there. And they're just specialized REITs. And so sometimes you just need to read a little bit more about them. But they lease space on communications. It's like cell towers, radio broadcast towers, and stuff. Kind of specialized stuff. Huge REIT, though, huge company. And now, if you want to know more about these, in addition to the business summary, under the company profile, they give the websites for each of these, and you can read more about each of these companies here. And, it's probably worth your while to do so as you look at these companies to learn more about them. Furthermore, and I'm not recommending any specific analyst reports, but a lot of REIT investors will look at the analyst reports. They're listed there, and just realize that, Schwab doesn't recommend these. They don't endorse what the analyst reports are. They're just a third-party report that gives you an extra opinion on those. And you can find extra financial information and we'll say qualitative information on these REITs in those that may be of interest to you, in addition to looking at the numbers. Now, you can look at the numbers here as well, and you can compare one company to another here on this. So, and there's the earnings, peer and ratio comparison, and in your financial statements down there. Okay? Now, I can't talk about taxes in this. I'm not allowed to, so I'm not going to talk about taxes today. But if we want to look at these, let me go back to this here. Let's go back and let's just kind of look at some of these. But I figured maybe let's narrow it down to more information that we may find of interest. So I'm going to modify this screen. Once you do a screen, you can always go back and modify it. How do you do that? You click on Modify Criteria. Once you've created a screen that you like, you can then save the screen. Okay? I'm not going to do it right now, but you click on Save Screen, you name it, and then you can go back without having to recreate the whole screen here. Now, I'm going to drop out that payout ratio here because, as we mentioned, that's not going to be relevant to us. So let me just X out that payout ratio. Debt to equity is relevant. Yield is relevant. And these aren't, recommendations of what you need to do. If we want to go to 2%, that's fine. That's no problem. If we say we don't want to go above 6%, that's fine too, per the risk discussion that we had before. So you can change this. Right now, I'm just going to keep this as is. But there's other things you can add. You can go to financial strength. Return on equity is something that we often talk about in this webcast. And I'm not going to put in a super high number here. We'll just say at least 5% return on equity. And valuation, you can use any of these. And let's put in just a PE ratio here. Now, what I'm going to do is I'm going to cut out those ones that have above 6% for our purposes here. And then what I'm going to do is I'm going to click on Evaluate. And here we go. We've got some REITs, and we've got a variety of REITs. And one thing I would encourage you to do, even if you don't narrow it down, if you want to narrow it down to a specific REIT, you can. But just adding in the industry, even if you're not narrowing it down, it gives you the choice of, it lets you see what sector or industry it's in. And all you do to do that is just go to Basic, just click on Sectors and Industries, and then I narrowed it down to REITs or real estate. But if you're just running a regular screener here on Schwab, not dealing with real estate or whatever, you're looking for stocks that have high growth rates or something, it's probably helpful. It's good information to know what sector it's in. Going back, of course, to that diversification discussion I had earlier. All right. So here's what I want to do. When you do the screen and you add in parameters, one thing is it does is it gives you the columns that you added. We added in debt to equity. I can see debt to equity here. I added in ROE. I added in price to earnings ratio. Okay, on there. So we can see where those are popping up and the yield, of course. So as we do that, you can go up here, American Homes for Rent. I'm just going to click on AMH here, okay? And then if you want more information, click on this. And then you can do your normal analysis that you want on this in terms of, you can see stock price, not spectacular over the past few years here. Remember, there is an interest rate risk here with real estate. If these are homes for rent, now this is in the Maryland well, it's managed by Maryland Real Estate Trust. It doesn't necessarily mean it's only in Maryland, but realize, of course, real estate is a very regional thing, and sometimes real estate in some areas of the country are doing well, and other areas of the country not so well. But when you look at this, you can get that information, and but think about, say, high interest rates, and think about the residential real estate market right now. And a lot of what you hear about on that is how expensive real estate is for younger people trying to afford their home, their first home. And they're just like going into I'm just going to permanently rent homes because homes are just out of touch right now. Or think of interest rates. Think of mortgage rates right now. Mortgage rates relative to the last few years are pretty high right now. And so that may be keeping some people out of real estate right now too. So that could certainly affect it. But you can see the dividend history here. And if you want to see more, you can click on Show More. Now, one thing about REITs, let me go to a longer term chart, and let me click on events here and show dividends. Okay, so here's our dividends, and you can see these right here. And you can see here they are. You can see those dividends, and they may go up, they may go down. REITs, a lot of dividend paying companies like to keep their dividends even or raise them and never try to lower them over time, because a lot of times investors consider that to be a bad sign if they lower a dividend. Well, because of that rule we set on REITs where they need to pay out 90% of their income in terms of a dividend, they tend to be more variable in terms of the dividends they pay out. So it just kind of, you got to look on a case-by-case basis on this. But you can look at the history on that, either on the chart like I just did, or there's also a dividend section here. On each of these sections, by the way, just click on Show More, and it will give you, more detailed information on some of those dividends here. And you can see their earnings and the beat, and then a beat or a miss, either way on that, their past earnings history. And you can compare one to another. So peers and ratio comparison. Let's click on Show More. These should all be REITs here that we're going to be comparing to. And so this can give you ideas of where to find other companies, other REITs that you may want to compare them to. Now, let me click on this and just mention, here's our dividend yield, a little bit shy of 4%. That's a fairly high dividend. Not ridiculously high, but this kind of highlights, you can see these dividends here, these kind of highlights an area where a lot of people will look and say that's what they like REITs here for, is the dividends that they pay. Furthermore, if you scroll down the page, you can see things like your ROE, your ROA. Sometimes people will look for a metric called a funds from operations, which you're not going to see. It's actually a non-GAAP type measure that you're just not going to see listed here. A lot of times on those analyst reports, you'll see funds from operations or adjusted funds from operations listed on those there. So just an FYI, you can get additional information on those. You can see price to earnings as compared to its peers there. And, analyst ratings, we already talked about. Growth rates, payout ratios, again, fairly high payout ratios on that. And just because it's mandated by law. And you can go down and you can see a whole bunch of other things, including things such as debt to capital ratios. Um, and that's about 40%, which is actually relatively low compared to some of its peers there. So that's uh, good, a good thing to, to compare, not just, it doesn't make much sense to compare a REIT to a semiconductor stock, probably. They're just apples and oranges. So you compare REITs to REITs. Now, can you do a similar thing on the Thinkorswim desktop software? Yeah, you can run a scan. The scanner here on Thinkorswim, what we call a scan on Thinkorswim in the Stock Hacker, is essentially analogous to the screener on the Schwab.com website. Most of the parameters you can use most of the parameters the same, like a dividend yield, an EPS, a PE. There's some differences. Like, for example, if you go and add a fundamental filter and you're looking for debt to capital, well, they do have long-term debt to capital. Debt to equity, I guess, is what they don't have. You can use debt to capital as a substitute on that. Okay. So I'm not going to go into the details on here, but you can do the same thing on the Thinkorswim website that you can on the Thinkorswim desktop software as you can on the Schwab.com website. Sorry, my chat disconnected there for a sec. So I'm not sure if it's reconnected or not, but I'd like to double check that. Now, there's another thing I want to do here. And oh, by the way, so if you decide you like it, then you can click on buy, or if you prefer to use the Thinkorswim desktop software, you can buy on that to diversify your portfolio. By the way, if you are using the Thinkorswim desktop software and you do decide I'm going to buy AMH or something like that, let me just pull that up, AMH, pull that up, and I say, well, I'm going to buy this. Come on. I'm going to buy this. For some reason, I accidentally clicked on. Let me try this one more time. And I buy this. One thing the paper money does not do is it's not going to show you dividends. And presumably, dividends are a huge part of your success or failure with your investment here in a REIT. So therefore, your paper money isn't necessarily going to be a great measure there for your REITs. Now, stock appreciation or the price appreciation is a factor as well, of course. In fact, that's one reason you don't chase super high dividends, is without considering the full picture, unless you think the company is going to be good, because you're going to lose a lot more money on share depreciation than you ever make in terms of the dividends that you bring in there. If, by the way, you do have a REIT in your live platform, okay, you do have a REIT in your live platform and you want to see dividends, you can go to monitor account statement and then go to, it'll show as payments under your cash and sweep vehicle there. Okay, so let me go and there's something else I want to mention here, and that is mortgage REITs. Mortgage REITs. So let me go back to our screener and let me get out of, I'm just going to modify this screen a little bit actually. So I'm going to go here and you can see these listed. You don't see any mortgage REITs here listed. And that's because mortgage REITs are not listed under real estate. Mortgage REITs are a different beast entirely. So instead of real estate, if you go to financials and you look, you will see mortgage real estate investment trusts. Now, these don't buy properties that they rent out or lease, unlike the equity REITs. These basically buy mortgage-backed securities or debt. Okay, so mortgage REITs act more like a bank or a lender in that regard than equity REITs do. Their profit primarily comes from net interest margin. In other words, the difference between the interest they earn on, from these assets that they buy and the cost of the money that they borrow to own these. These typically have very high debt levels. These are very highly leveraged instruments. Okay? Very highly leveraged instruments. They tend to be much more volatile as well. So know what you're getting into. Mortgage REITs typically, and of course these are all generalizations I'm talking about, are going to have higher yields, higher volatility, and probably we'd say, kind of goes hand in hand with higher volatility, is we'd probably say maybe a higher risk. Now, if you make the calculated decision in your portfolio that you want to take some of that risk, then, they're a possibility for you. But remember, these are going to be very interest rate sensitive assets here when you look at these. So those are our mortgage REITs. Let me go and just get rid of this and just pull this up here and give you an example of some of these. So here's Arbor Realty Trust. I'm going to click on this and let's pull this up. And we're going to see the company. You can see it hasn't done very well there. Let's look at the annual, trailing 12 months annual dividend yield, 19%. Okay, so the uninformed investor may go, "Wow, that's awesome! I'm making almost 20% in the dividend." Well, keep in mind what's happened to the stock price, and when I look at stock prices, of course, the past doesn't necessarily indicate what the future is going to do, but this is a 6-month chart. We've gone down from what, $8.50 to $5.50. It's like a 30+% drop. It's hard to make up for that in terms of the yields, the dividends that you bring in on that. So that's just an example of, obviously not all mortgage REITs are the same. So I don't want to make too blanket of a statement, but just be cautious when you look at those mortgage REITs. They're not equity REITs. They're different beasts entirely. And so the focus today on what I wanted to talk about is those equity REITs there. Okay. Now, I want to answer, we're running out of time, and I just want to answer any questions that we have there. And Paul in the chat mentioned my opinion, avoid mortgage REITs. Okay, I can't tell you to buy or to avoid anything, but just be aware of your risk. And Paul's opinion is not an uncommon one either. So a lot of people do that. So there we go. Now, let's go can you show us how dividends factored in price chart? Yeah, so you can do that. I'm going to go to the Thinkorswim because it's a good way to do that. We were just looking, what symbol we're looking at? ABR. Let's look at ABR. Okay, let's go to, here's a chart. Now I think this is adjusted for dividends already here on this one. Adjust for dividends. Let me do this. I'm not going to adjust for dividends. So this is what the actual price of this REIT, was the mortgage REIT, was over the past several years, since 2021, it looks like. Okay. High 20 down to now $5.50. On Thinkorswim, something you can do is you can go to equities and then adjust for dividends. And I'm just going to say all. I'm going to apply, click on OK. And you can see the whole price chart changes. In fact, let me do this. I'm going to put this on a different screen. And I'm going to click on adjust for dividends and not adjust for dividends so you can see the difference here. I've got to get on the right thing here, though. Adjust for dividends, those are adjusted. Here's not adjusted. Significant difference from $20 here down to, or to, $13. So this, by adjusting for dividends, you can kind of factor in, if you want, how much the dividend is affecting the share price there on that. All right. Okay. And keep in mind with dividends, they can always be cut, right? Paul said ABR cut its dividend last May. Probably not surprising there. Very often highly leveraged, these REITs. All right, everybody, I want to thank you for joining me today as we discuss primarily equity REITs and the possibility of diversifying your portfolio with those, and hopefully some information on those that you found valuable. I appreciate you joining me. I encourage you to subscribe to the Trader Talks channel on YouTube. It helps you to see content that is of interest to you in the future, of course. Also, if you liked the webcast, I'd appreciate it if you click on the thumbs up. It helps me out. And it also helps out the channel and helps out the cause of free education. So I appreciate you. I want to thank Connie in the chat, of course. Connie's always a great help. Make sure you follow us on X at Brentmore CS, at Connie Hill CS. Coming up next, we've got Trading the Trend. That's coming up at the top of the hour. Thanks, everybody. Have a wonderful rest of the day. We'll see you same time next week. Bye-bye, everybody.